Welcome to the second in a series of tax bill series for CalCPA. I'm Annette Nellen, professor at San José State University. And on this episode here, I'm going to highlight things that we should watch out for in a bill because there could be retroactive provisions. And there are retroactive provisions in the HR 1, the One Big Beautiful Bill. Most of these retroactive provisions are very favorable so far as reducing your taxes. So we have a slight increase to standard deduction starting for 2025, increase in the child tax credit to $2,200. We have an increase for the SALT cap. We expect it to be $10,000 for 2025. It will be up to $40,000, but there is a new phase out that will affect maybe some of your clients, pretty high income level, that would start at modified AGI level of $500,000. Enhancements to the adoption credit, use of 529 funds for certain post-secondary credentialing expenses, something I should promoted by the AICPA, because I think that would pick up like you're getting ready for preparing for the CPA exam. Trump accounts are new, and I'll be another on the series getting into the highlights of that, but there was a benefit for children born actually starting in 2025 through 2028. The deduction for tips and overtime income starts 2025, the interest on certain personal car loans. And then there was two places in the law where it deals with casualty loss, but one of those does deal with qualified disasters, changing the dates. It's always very puzzling, and I sit on the task force for the AICPA disaster relief area, and we all of us puzzle, what exactly does this obtuse language mean? And we are just process today, I guess, of sending a email off to the IRS. Could you actually update Pub 547 to specify exactly what qualified disasters? But it looks like it will be picking up the LA wildfires as being a qualified disaster, which means it gets better tax treatment for the losses. Additional ones, we're going to go back to expensing domestic R&D starting 2025, 100% bonus depreciation, and here's one. It's 40% for the first 19 days of 2025, then goes to 100% thereafter. And a new provision expensing production property will start this year. And then the higher threshold for how much interest can be deducted under 163J goes back to the more favorable one. And then we actually have renewal and extension of opportunity zones with some of those dates actually effective for 2025. And there'll be a later series covering some of the highlights there. Additional ones here, I mean, just a long list of things actually do start sometime in 2025. Change on percentage completion. The 1099K filing threshold, which had been dropped by the American Rescue Plan Act back in 2021, it's going to go back to what its 2008 version was, which I have noted here. So there'll be fewer 1099Ks coming out from PayPal and things like that. You see a few new provisions here as well. I'll go through the details, so you'll have a copy of the slides. But just want to highlight, we always have to watch effective dates. Some actually are for 2025. Those are ones that would be tax cuts. Just to highlight, some individuals are going to see a tax increase. The child tax credit, they'll continue the requirement that the child has to have a Social Security number, but the final bill does include that the person claiming the child has to have a Social Security number, or if they're married, at least one of the spouses has to have a Social Security number. That is retroactive to 1/1/25. And then the employee retention credit, there is a variety of changes in there. And then this is where you got to read the fine print. It will deny claims filed after January 31st, 2024, but it makes a reference to Code Section 3134, which only covers ERC that applied for the last two quarters of 2021. All right, then we have acceleration of some termination date. Most of the energy credits that were in the law as modified or added by the Inflation Reduction Act, we're going to be in there, especially individual ones, through 2032. Significant change here, which you want to let your clients know right away. The clean vehicle credits, including the used and the new one, it must be placed in service by September 30th, 2025. They'll have to take possession of. I'm guessing there's going to be some great sales through the September 30th on these cars. Then the residential energy credits under 25 Cap C, 25 Cap D, they're going to terminate at the end of this year. So, for example, if someone's like, oh, I'm going to put those solar panels on someday and get that great 30% credit that'll even carry forward, they'll have to be installed by the end of the year. So they would want to move quickly on that. Then many changes in the business energy credits will leave that for a future podcast here. And then there's just caution on things, not to overlook. Some provisions are only available if they file married filing joint, as I note here. Some provisions are going to say, hey, you have to have a social security number. And for example, even adding starting 2026 to claim the American Opportunity Tax Credit or lifetime learning credit, you would have to have the social security number. Also, on the interest on the car, this is where things change. The House version had said, hey, that car could be new or used, must be assembled in the United States. But the final version is only for a new car. Of course, they cost a lot more than used cars. Some planning considerations to think about. Certainly, when we have phase outs, that's where to watch. Well, yeah, I'm going to do like a Roth conversion. Well, is that now going to cause you to go from 40,000 SALT cap to a 10,000 SALT cap? And what's the effect of all that? Of course, if you have good planning software, Excel spreadsheets, whatever you're using, that'll help catch some of these. And you want to analyze all aspects of a transaction before just blankly saying, hey, there's this great deal about getting a deduction on your car loan interest when you buy a new car. Well, you can see a blog post I did recently, if you look at 21st Century Taxation blog, where most people are really not are better off buying a used car or a less expensive new car, because realize the interest is then just the tax savings of that amount. If you're at a 10-12% bracket, that's not a lot of savings compared to other factors in buying a car. So be careful how you're watching all of this. Planning considerations, obviously, if the energy credits, that require some immediate planning if you're going to take advantage of the vehicle or the residential one. Obviously, for some individuals, the planning will change from going from what would have dropped to a 6 million estate and gift exemption in 2026. It'll be 15 million going forward. The Trump accounts, but then it's the planning of, well, is a Trump account better than a 529 versus a 530, or should I have all of those accounts? What makes sense there? There are also significant changes to the premium tax credit, and I know for the last few years, some folks may have been using premium tax credit, and maybe some of you, because they removed that threshold that now for 2025, it was okay to have household income greater than 400% of federal poverty line. That was not renewed. That would expire starting next year, and there's other changes there as well. So even maybe checking for folks who don't have employer-provided health insurance, what are they doing? And there's some effects there, plus some favorable things actually for health savings accounts. Planning also relevant to choice of entity. For example, if someone's going to start a business, I got this great, Gen AI activity here, and they're hoping, hey, someday someone's going to buy, it's going to make a lot of, money here. Maybe they actually want to start as a C Corp, assuming it's a qualified small business corporation, because the thresholds went up on that. Obviously, planning with the permanent lower rates, permanent QBI deduction at 20% going forward, and then the SALT cap being raised. Obviously, those things have some bearing on your planning. Some new compliance concerns. I hinted at these in the first of the series here. There will be a few less 1099s being received starting in 2026. That threshold of $600 will get bumped up to $2,000, adjusted for inflation. And either because of poor record keeping or people don't remember that, or don't know that doesn't matter if you get a 1099 W-2. If it's income, it's taxable. You have to report it. So you'll be thinking about, how will I know if I got clients that, are getting, 1099s before and it was 600, that might not get them when it's 2000. Is there record keeping in place? And do they know it's still taxable? Many people will interpret that as, hey, we got a tax break if it's under $2,000. Also, made permanent is above the line charitable contribution of cash donations. It'll be 1,000 or 2,000 married filing joint. And here, a lot of folks just don't understand charitable contribution rules. I think, oh, I put money in a GoFundMe site, or gee, I gave a struggling student, I just handed them money. Isn't that a charitable contribution? No, all the documentation will have to be therefore a qualified donation of cash. If it's $250 or higher, they must have the contemporaneous written acknowledgement. And for any amount of cash donation, you always must have proof of what amount it was and where it was given. Also, for businesses that placed property in service that was eligible for bonus depreciation the first 19 days of 2025, they're going to be very inclined to say, no, I really didn't place it in service then. I really placed it in service January 20th or later. I get 100% bonus. So we're going to step forward and say, well, no, we have to do it the proper way here. All right. Well, I hope I've given you some things to be thinking about and getting into the bill. Here is a list of upcoming episodes in this series here. And of course, other CalCPA programs like Titans of Tax. I look forward to seeing you later this year. We'll delve into many of these, and some probably will warrant, a webinar to delve deeper into like qualified opportunity zones and things like that. And then just one final point. This is the end of tax legislation for the year. Perhaps not. Obviously, we need an appropriations bill to fund the government. Sometimes tax provisions go in there. For example, they have not renewed the work opportunity tax credit that expires end of the year. Maybe that'll go into appropriations bill. There's a bill with lots of practice procedure items in there with bipartisan support. The Taxpayer Assistance and Service Act, and maybe that comes back and gets attention. Senator Lummis has updated her tax bill with the changes for digital assets. That might get some attention, and who knows, perhaps other things as well. So please stay tuned for additional presentations in this series on the new tax legislation. And thank you very much for being here.